Good morning, everyone. Welcome to webinar number 122, which means we have, sir, every year we conduct 24 webinars. And with that, we have crossed 5 years, and this is the 5 years plus 2 months actually. I mean, thanks to you, Mr. TV Balasubramanian is well known to our BBA family. Mr. TV Balasubramanian is partner at PKF. Sridharan Santanam is a fellow member of Chartered Accountant and a registered valuer with over 2 decades of experience in business valuations, strategy consulting, forensic analysis, and due diligence. He has led assignments across 20 plus countries and contributions actively as a faculty and advisory member with ICAA RVO. Now, over to you, sir. Welcome.
Thank you. Good morning to you all. Nice to be in, in the early morning session with participants. Yes. Now, let me first share the screen and then we can take it forward. Yeah, hope the screen is visible and we can go forward. What we can do is, I thought today, I will take you through whatever I have put here in my presentation, and then maybe keep aside 15-20 minutes for any general queries on ESOP, which we can discuss, which is not in the slides also. To the extent we can all share some thoughts on it, it will be helpful to everyone. So probably at the end, I will keep aside 15-20 minutes for any discussions we can have generally. And I'll stick to the timelines. I know on 9:30 you all would like to leave for your work for the day, and probably some of you are attending the 2-day seminar also. So we will keep to the timings, right? With that, let me start on this. Some basics I'm going to touch upon because I don't know how many of you have already been doing ESOP valuations. So I will take through the basics in a little faster way, and then we'll look at some specific issues and thoughts where there are complications which are there, and generally what happens in the world. Now, on an overall basis, let's first look at the requirements. What are the ESOP requirements? When does the valuation requirement come up? Let's broadly look at it as at the time of grant and at the time of exercise, because all our accounting is based on valuation to be done at the time of grant. The purpose there is for accounting, purely for accounting the ESOP costs by the company. So that is the valuation which is done at the time of grant. There is also a valuation which is required at the time of exercise. That is to determine the perquisite value in the hands of employee. I also understand that there is some change happening in the perquisite value determination and all under tax in the coming bill or something, but I am not aware what exactly is coming. But I heard from somebody that there are some changes coming, or some value limits which is being brought in, increased. The second is, on what basis is the valuation to be done? For the purpose of grant, it is under the Companies Act and Accounting Standard. For the purpose of exercise, it's under the Income Tax Act. So who is currently eligible to do the valuation? Under the accounting, it is the registered valuer. Of course, there are people who take a view that because it is under the accounting standards and not directly under the Companies Act, I can get a chartered accountant to do the valuation and it need not be a registered valuer. But my own personal view is the interpretation has to be that anything under the Companies Act and accounting standards also come under the Companies Act. It is more conservative and appropriate probably to take a view that it is covered under Companies Act and a registered valuer does the valuation. At the time of exercise, it is by the merchant banker under the Income Tax Act. There has been no change as set in the this thing. So there is a need to go for perquisite valuation to be done by a merchant banker. And what is to be valued at this time? This is also very important. In the case of a grant, we have to value two things if the company is unlisted. First, we have to value the equity share. Without valuing the equity share, you cannot value the options. The second part is to value the options. In the case of exercise, if it's a listed company, obviously there is no valuation required if the ready price is available. But it's an unlisted company, the equity share will have to be valued. One of the key things we also need to bear in mind is if there have been other valuations for any other purposes which have been done around the same time, one has to consider that and probably appropriately take note of it. This is not to say it has to exactly match with it always. There could be reasons for some difference. But if there is a reason for difference, that has to be very clearly documented either in the work paper or in the report as may be required. So that is something which is very critical. Now, this is generally on ESOP, but if the ESOP were more like a SAR, right, stock appreciation right, where basically you are going to pay out cash based on thing, then the valuation which we have to do may have to be done at each period end. I've just put here end. It could be even quarter end if you are doing quarterly accounts. So every period end, you need to revalue this is the theoretical requirement. Now, practically and pragmatically, in many companies, unless there are significant changes, they may take a valuation report for grants which are done in, say, 6 months or 1 year. They may continue to use the same thing unless there are some significant changes which are happening. So this is something which is practically done, and it is practically accepted because primary purpose is for accounting, and it is then the concept of materiality and a fair estimate, all that comes into play. So by and large, half yearly valuation, unless the company has significant changes happening, may be acceptable, because these are practical things also which we need to have ready. The same thing happens with exercise valuation also for perquisite, because companies may have exercise happening on various dates if they have kept it very flexible. So you can't keep on getting valuation reports. So some reasonable intervals are practically and pragmatically used for this. Now, I'm going to more talk about everything around the formula. The formula is Greek and Latin, and we don't really need to know the formulas. Formulas are readily available of templates, etc. But we need to understand what is happening and what is the source of data. So I'm more going to talk about those than the formula per se. Of course, the template, this thing, even in an Excel, I'm going to be sharing it also. I'll take you through that also when we are going through. But let's focus more on what is required for it from a very practical valuer's perspective. Now, first is the underlying stock price. To value the option, the first and foremost thing required is what is the underlying stock price today on the grant date. In the case of listed shares, it's easy, market quotes are available. In case of unlisted shares, there is a need for valuation to be done on the shares. Now, here also, just one quick thought I will add. In the case of listed shares, in India, the SEBI guidance specifically states you have to take that date's value or something simple. Whereas internationally, there is no such prescription under any law. So there is a possibility that you might take that day's value, or you might take a 1 month average. There could be also spikes in the market. So typically, internationally, there is some balancing which is done. But in India, if it is listed, you go by the SEBI guidance, which will have to be adhered to because it becomes a legal requirement. Unlisted cases, there has to be a valuation of shares as on that date. which is done. Then strike price is generally very easy. It is the price at which it is exercisable as per the scheme. Now, where there can be complication in this is even the strike price is kept as a variable. If it achieves so much, it will be X. If you achieve so much, it will be Y. Like that, there could be some criteria which is put. But generally, the strike price is based on the contract or scheme. It is determined. Time to expiry of option is generally taken as per the scheme or contract. Now, what is time to expiry? It is the vesting period plus then the exercise period. So let's suppose if there is a grant today being made with 4 vesting dates, 1 year, 2 year, 3 year, 4 year, and each of those can be exercised in next 3 years from the time it vests. Then for tranche 1, the full time to expiry is 4 years, which is 1 year plus 3 years, 4 years. For tranche 2, it is 5 years. Like that, it goes on. Now, in some cases, we may have to again apply our mind here. Generally, we could take that. But let's suppose the exercise period is 10 years. Now, you need to take also cognizance of the possibility that there could be early exercise. So in Ind AS 1 or 2, there are specific paragraphs which deals with early exercise, which can be considered and appropriately applied. What is the rationale for this? If I take 10 year, then the valuation will be X, the option value. If I take 5 years, the value will be probably 20% less in some cases. So the question is, will the early exercise happen and will it have a material impact? So that is something which also needs to be considered because it has immediate implication on your estimate for accounting. So this is something which needs to be considered. Volatility is one key area which requires attention. I will discuss a little more on that in the next slides. So we'll park that for a moment. We'll finish the other things. Risk-free rate, you can take based on GSEC yields. Data is readily available always, so you can use that. P34 of Ind AS 1 or 2 is talking about zero coupon government bond yield for term consistent with expected exercise period. So again, if there are 4 tranches, ideally we should take 4 different risk-free rates which are more appropriately aligned to each exercise period. So in the example we were talking about, there is a 4-year, 5-year, 6-year, 7-year period for expiry. So for each tranche, we should take the risk-free rate which is more appropriate or more close to that. 4-year, 5-year, 6-year, 7-year. Then dividend yield could be based on historic trend or based on future estimate or generally what is happening in the industry, etc. could be the guiding factor. There could be some small impact because of dividend yield in many cases. Very rare cases, there could be a significant impact also. So that also needs to be factored in the Indian context, right? Now, I'm purely talking from the Indian context as to how we are doing it in India. Now, let's look at volatility. As we were seeing in the previous slide, many of the other things are readily available or easily determinable, except in very complex schemes. But volatility is something which is not so easily and readily available. In the case of listed companies, fine, there is a volatility available for the listed scrip itself, so you can go by that. So you can use the historical data, and from the historical data, it could be based on your own scrip if you are listed, or you can use comparable scripts in that industry and take those volatility, maybe take an average of that, etc. So that could be the other method by which it can be done. So one is based on historical data. The second is, in some cases, there could be options which are currently traded in the market. So whenever there are options which are traded in the market, then there could be implied volatility available from those. Those implied volatility could be used. So these are the two broad methods by which volatility can be taken and used in your workings. Now, at this point, I'm also just going to take you through how to compute volatility. I'm sharing this file, so I've just put here for 20 days, but actually you should take a long period for volatility computation. So you take the prices and you see what is the movement, variance. And from the variance, you calculate the standard deviation. Standard deviation is for the number of days trading which you are comparing. And then from that, you can extrapolate for a week or for a year, whatever is the period you need for. So this is how you can compute volatility yourself using the base data which is readily available for your own script or comparable scripts. Of course, today in many websites, there might be ready availability or published volatility numbers. You can use that also, right? But these are sources for getting the volatility numbers. So this is what we were looking at in the Excel sheet. Let's skip to that. So how is volatility useful? See, the whole thing is that there is a basic assumption which is there that the probability is on a normal distribution of how the price grows, what stock returns come, right? Follows a normal distribution is the basic one of the assumptions underlying this whole thing. So what does this standard deviation mean or the volatility mean? So let's look at an example. Let's say today the price is 77. Now, what is the price it can be tomorrow? This is what the deviation or volatility is really talking about. So if you take the daily deviation of 1.61%, then under the assumption of normal distribution, what it means is that there is a 68% probability, that is 1 sigma, within 1 sigma, 68% probability that the 77 rupee today's price will go down up to 75.76 and go up to 78.24. So it will be within this range of 3.5 rupees by tomorrow with a 68% probability. Now with a 99% probability, it will be between 80.72 and 73.28, which is the 3 sigma level. So this is what volatility is all about. So the distribution, normal distribution is one of the underlying key things which are applied in the whole Black-Scholes option computation model. Now, how is it theoretically there and useful? Is there are many things in our common world which is, for whatever be the reason, following normal distribution. So this was, the famous thing is about this bean machine, right? He took beans piece basically, and he demonstrated in a triangular this thing that when you pour from the top with interleaved rows of pins, broadly it gets distributed on a random basis, but the random distribution forms a bell curve. Why? Nobody knows, but that is part of the normal distribution pattern. So many things in the world's operations are found to be following a normal distribution. And in the normal distribution, the expectation is about 68% will be within 1 sigma from the mean, right? And 99% plus will be within 3 sigma mean. So this is exactly what is being included in the Black-Scholes model.
Curtis is it?
Sorry?
This is the Curtis.
Ravichandran sir,
yes.
when you are logging in two systems, no, the echo will come. So you have to mute.
Mute as well as mic switch off. That's, yeah.
He's trying to say something, looks like, but I don't know.
Yeah.
Yeah, you are muted,
Maybe.
Ravichandran sir. We couldn't hear you anything.
I think this is Curtis. That's what I said.
Yeah. So all what we would have studied in school, now after that we have given up. Of course, all this is the theory behind it. Basically, why volatility is so important in using. The reason is that even the stock price is expected to normally follow this normal distribution, which has been again by many studies shown that it does in fact go by that. So now with that, let's also look at some quick common option pricing models which are used, right? And I will also share some interesting trends in that later.
Sir, good morning. Senthil here.
Yeah,
I have
morning.
some questions. Can I go ahead or should the questions be parked to the end?
We can do either way, sir, but maybe to ensure that we don't skip the time lines, if we can keep all the questions, we can take it together.
This
that would
was
be
actually
better.
on like volatility, sir.
Yeah, please.
Should you take the data for in correlation with the time of the life of the option? Okay. Or if you have limited set of data, as you said, like you demonstrated for 20 days in your example, like you say, take 1 year data, then you extrapolate for the correlation with the life of the option. What do you generally?
Sir, the life of the option and the volatility you take is not related.
Okay.
Volatility is what you estimate based on a long data for ensuring that the normal distribution is better represented. So 3 years to 5 years data you should use ideally.
Okay.
That would give a better indication of the volatility over a long period.
Okay. It need not be correlated with the life of the option.
No. The thing we correlate with life is the risk-free rate.
Okay.
Risk-free rate we take based on what is more closely related to this thing, the expiry period.
Thank you, sir.
Right, no problem. So the most often used model is the Black-Scholes option pricing model. Black-Scholes is probably the easiest and simplest one which is people use and largely used model. So here there are some assumptions which may not necessarily match with your ESOP necessarily in some cases. So that also I will highlight. So the basic Black-Scholes model assumes no dividends. There is also a Black-Scholes-Merton option pricing model which provides for dividend to be included. It also assumes there are no transaction costs. And then it assumes that the risk-free rate of return is constant. For example, those who have done ESOP valuation over a long period, there are two options. You can take the same discount rate for all the period, or you can use differing discount rate for different periods. Here under the Black-Scholes model, you use one risk-free rate only across. So that is another assumption. And the market can be in any fraction. This is another assumption. So there is no lot size. There is no such complexities which are built into this. And there is also no penalty for short selling. So that is also another consideration in the Black-Scholes model. Then the most important thing is in the Black-Scholes model, the exercise is assumed to happen only on the expiration date. So when we say 5 years, it is assumed at the end of 5th year only it will be exercised. But as we know, many options are exercisable anytime in the between the vesting and exercise period. Many, not all, many. But that is not provided for in the Black-Scholes model. So that is where the assumption about early exercise becomes important to consider also. Then it assumes that security trading happens over a continuous period of time. There is no step up date-wise or period-wise in the model. So this is what is the basic assumptions underlying that. As I was mentioning, Black-Scholes Merton model has one additional thing, that it also considers a discount, sorry, the dividend. So that is the added thing which is in Black-Scholes Merton model. So when we use an Excel model, generally we use the Black-Scholes Merton option pricing model, which builds in for the dividend also. Now, there are many international models which will be available in Excel and all that, which will also provide for early vesting, late vesting, lapsing, right? Because there might be some attrition for employees, etc., which are built into the pricing model itself. Under the Indian context, the guidelines are clear that you identify this, you make changes or make adjustments for that in the quantity you determine. So if you are giving 10,000 grants today, you calculate the value per option without considering any attrition, etc. But then you can maybe make an assumption out of the 10,000 grants, only 90% will achieve the criteria. So 9,000 grants only we will value, not 10,000. So that is where you make the adjustments for those, not in the pricing. Like I said, the model for the pricing, we can leave it. The formulas are readily available. We can just use them. Ready templates are there. I will share the template also. Like I said, 3 things are critical in this. It assumes normal distribution to be the pattern, which is very critical in this. Second is volatility, very, very critical in computing the auction valuation. The third is what is going to be the expiry time, whether there is going to be early exercise. And in that, the important thing is Black-Scholes model considers that the exercise happens only at the end of the period, not during the period. So these are some key things which we need to understand. So this is the first model and most oft used model in India. Let's look at the other models also. Now, what I have done is I am going to share the Excel, but whatever I have put in Excel, I have also put it as a formula and given in the presentation. So anybody can construct this in Excel very easily. This Black-Scholes Merton option pricing computation can be just done on the same basis if we use the row and column as defined here. I'm also going to anyway share this Excel sheet. Now, we were looking at the various inputs which are there. Now, what is the impact that it has on the pricing, option pricing? So whenever the underlying stock price goes up, effect on call value is going up. On put value, it goes down. The strike price changes upwards, then call price drops. But if you take time to expiry and volatility, the more it is, that is the more increase it is there, both call price and put price increases because the possibility of being in the money or out of the money becomes more in that. Risk-free rate increases, the call price increases. Dividend yield increases, the call price decreases. So these are the impacts and implications it has on the value determination. So coming to binomial option pricing model, but before we go into it, yeah. So the second model is the binomial option pricing model. We can look at all the questions together, I thought. Okay. So just looked at it, but then I thought better to take it together. Okay. So in the binomial model, there are some different approaches to it. It is a discrete time-based model. So it's a step-by-step movement which is taken. So time interval, daily, monthly, yearly, right? And it's assumed that at these time intervals, the stock can only jump one way. It can either go up or go down. So it cannot be multiple things. So this is what is the crux of binomial model, where it is assumed that there will be a step-by-step movement upward or downward, which will be happening on a discrete time period. So theoretically speaking, every trading day we can compute like this and go, but then, it becomes mammoth to compute large periods. The advantages of binomial model over Black-Scholes model is it handles early exercise and vesting conditions realistically. For example, binomial model considers that it can be exercised anytime during the exercise period. Whereas Black-Scholes model assumes it can be done only at the end of the period. Then there are certain other vesting conditions also which can be built in, because this is manually you can build a tree. So you can have multiple conditions and complications which can be built into this option pricing model. And it can estimate fair value per tranche accurately for multiple vesting dates. So, but that we can handle in Black-Scholes by having it as 4 different vestings, right? So these are some key things which makes a significant difference. And because it is manually built, you can even have changing assumptions. That is the volatility changing, the probability changing over a period, all that can be built in. It's a flexible model, but requires a lot of computational efforts. That's the cons. It is data heavy. It requires a lot of inputs if you want to build it like that. And you have to do a lot of work and computations. That is the significant cons on binomial model. So typically, this is how the binomial model goes. From a stock price, the stock price can go up or stock price can go down. Then from that state in the next time interval, again the stock price can go up or it can go down, or from the down, it can go up or go down. So like this, the tree gets built. So look at a complex structure where binomial is possible, but not under Black-Scholes, right? Stock price at grant date is 100, exercise price is 100. Now, instead of a single volatility, I am having two possibilities, right? Possibility one is that there will be a 15% growth. Possibility two is 5% growth. And the vesting criteria is if market price at the end of year 2 is 115, options vest. Otherwise, it expires. And risk-free rate is 6%. Now, this cannot be built into the Black-Scholes easily, whereas in a binomial tree, you can build it. So let's look at this example. So first is you build the tree. So at the start of this thing, it is 100. It can go up by 15% or 5%, two possibilities. So it can become at the year end 115 or 105. Now, if it became 115 by year end 2, it can grow another 15% to 132, or it can go 5% to 120. If in year one, it actually grew only to 105, 105 can grow by 15% to 120, or it can grow by another 5% to 110. So these are the 4 possible scenarios which can come at the year 2. In the first 3 scenarios, because it is over 115, because there is a price criteria which is there, it vests. In the 4th, because it is below 115, there is no vesting happening, it gets cancelled. So the value which will come will be 132, 120 or 125. And the last one is 0. So considering those 4, right, as the outcome, you work backwards to compute the payoff for upstate and downstate for year 1 to year 2 first. So once you do at year 1 to year 2 using the formula for that, you will arrive at 2 values as the upstate payoff and downstate payoff as 115 and 11. Why it is coming so low to 11? Because in one option it becomes 0. Nothing will come, right? So this upstate and downstate, when you work back to year 0, it comes to 20 rupees. So that is how you can calculate a 20 rupee option value. So what is the value of this option? It's 20.52. By using a binomial model, this can be built. Whereas by using a Black-Scholes, it is difficult. This is where binomial also has a room to play, and binomial is also used in some cases. So these are the formulas for this. As I told you, wherever possible, I am also sharing all the formulas, etc., alongside, so that it can be useful in your actual work whenever you want to do something or you want to build your own model, etc. The third is the Monte Carlo method. Monte Carlo method is not something separate and new. It is a fine tuning of one of these existing methods itself. Monte Carlo method is basically randomizing something in between. That's it. So you do a lot of iteration randomizing something and use a Black-Scholes or a binomial model to arrive at what could be the value. So let's take an example and understand what it is, right? Let me take you to the Excel sheet. So as I told you, I have the Black-Scholes-Merton option pricing model here. I also have a basic, just an example of a 5-year binomial option pricing model here, right? We will see that I will share this so you can use it later. Now, this is a Monte Carlo method model. Now, in this, what are we doing? We are basically taking the same Black-Scholes model, right? We are using the same Black-Scholes model, but determining the value based on iteration. So here we have used 5,000 iterations to iterate what could be the stock price at the end of the period, right? In that, we are applying a random modifier, right? So by doing some 5,000 iterations, we are getting so many options, and you can take an average of that to determine what will be the likely call price, which will be there, right? This is too sophisticated. Now, let's just take a simple example, right? If it is going to be done in the same thing in, let's say, Black-Scholes model, I take the same 100, 100 and 6% risk-free rate. 6% risk-free rate, and period is say 0.5, and volatility was 15, if I'm right, 15%, right? And dividend 0. Now Black-Scholes gives 5.81 and Monte Carlo gives 5.86. So the Monte Carlo is more useful, not for straitjacketed this thing, but where there could be some other complexities. It would be more useful. For instance, if I want to randomize the period, I can build a model based on what is the probability that somebody will take it in half year, 1 year, 1.5 years, like that. So it can be built for any kind of this thing. Here, the randomization has been done for the stock price, which will be there at the end of the period, right? Not the this thing. Whereas you could randomize any one of these complexities, like expiry period. You could work on that. So this is essentially Monte Carlo. Monte Carlo is only using one of these methods in a multiple iteration, huge number of iterations. So basically, it's all possible only with regard with the tech support, IT models which we can run. So what are the different types of options? This is more for understanding. European option is expected that it gets exercised only at maturity. Like for example, Black-Scholes we saw is based on European model. American model is it can get exercised anytime up to maturity, which is what we saw will generally be built into binomial. Asian model is the payoff is computed based on an average price over a period. Now, these are very complex models to build. These are things which are available in the market. There are Asian option contracts which are there in the market for some traded products, right? But these are much more complex to build and normally not used for ESOPs. Just touching upon more to give an idea, right? These are generally used for currencies or commodities which have lower volume of trade. So largely we stick to European and American models for ESOP valuation. Now we saw the different models which are there. So, but what is the trend in India and what is happening globally? Right? So that is something which I thought we can talk about. In India, the trend is for corporates to use other than Black-Scholes model only in 20 to 30% case. So nearly about 70 to 80% of Indian ESOP computations today are based on Black-Scholes model. Why is it so? It is very simple, very easy, and largely it is for accounting. So it's an estimate. You can be a little way off on estimate. It's not that, it is some settlement is being made basis that. So it's an estimate. So largely people go by the Black-Scholes model, which is easy to compute. For instance, I will take some classic examples as we go also where binomial is done. But in comparison, you see what is happening in the Western world. Non-Black-Scholes model are used in about more than 50% of the cases. See the significant difference. In India, we use less than 20-30%, whereas internationally more than 50% is binomial or other models, which is being used, right? So why is that a big difference which is there? Regulatory acceptance for both methods. Black-Scholes is generally cost effective even when for companies when they give it out to valuers to do valuation. If they are going to ask for Black-Scholes model to be applied, it has less complexities, it has less working to be done. So it is always more cost effective. The second reason is in the Western world, there is much more richer data set available for various other things like early exercise experiences, employee attrition. So if you take the US model, unlike IFRS and IND-AS, which says you calculate the ESOP price, then any adjustment for employee attrition, etc., you do it in the quantity, not in the pricing. Whereas the US model, everything gets adjusted in the pricing itself. So for all that, you need significant amount of experience data, etc., which is widely available there compared to the Indian scenario today. So in India, when do you find binomial is used? When they have some complex option terms, then only I generally note that they are using binomial. If you ask me, is Black-Scholes enough? Largely, yes, unless there is some significant complexity, yes. Because like I said, ultimately it is for counting, and a few percentage variation in that is not going to be material. So let's now look at some examples and how it is dealt with in binomial versus Black-Scholes. Let's take early exercise option, right? Now, in early exercise option, so essentially, let's say we put in a condition that if the price reaches 200, it will get exercised. Because binomial is built as a lattice, right, a tree, it is possible to build this condition also there, saying, okay, boss, in this tree root, if it is reaching 200, it gets exercised at that time. Other roots will continue till expire, right? So this is the advantage there. In Black-Scholes, this is not readily provided. So how does somebody apply this? This is applied by using, instead of the full term, an expected life term. For instance, there was a case where the company was issuing a listed company was issuing ESOP. 100 rupee was the current market price. I think the excise price was somewhere around 30, right? And after the vesting, it had a 10-year life. They can exercise anytime in 10 years. And mind you, this is a listed company already, right? So look at it. It is already in the money on day one by 70 rupees. Then by the time it is says, and then you have 10 years, it's a long period. So somebody who gets 5,000 shares will immediately see 5,000 into 70, 3.5 lakhs today. And by the time it vests, probably it is 7 lakhs. I'm just giving an example. So the likelihood of early exercise was high. So based on some past experience and the type of people to whom the shares were being given, it was determined to take, instead of 10 years plus vesting period as the exercise period, we had taken that exercise will happen within 6 months of vesting maximum. That's how the calculation was done. And this was a significant difference. There was a 25% difference in the cost which was being accounted based that too. So this can be one method of handling it in Black-Scholes model, a crude method, but yes, a practical method to do it. So for that, what can be done? You can look at the behavior, employee exercise behavior, which considers what is the value involved in this, vis-a-vis what is the type of employee to whom it is being given, mid-level employee, lower level employee, or very senior employee. For example, if you give it to a CEO, CXO type, something like this, they would not be bothered about 3.5 lakhs coming in cash immediately. They would say, okay, let it keep invested. In 10 years, I would make a huge pile. Whereas a junior level person might immediately encash. So these are the things which will have to be also considered in determining the period which we are going to consider there. So this is the way it can be addressed in the for the early exercise option. So let's take a classic example. Assume a scheme where vesting and exercise happens when the price crosses 200. Like I said, this can be only done by making some assumption that in 5 years you will do it, 2 years you will do it, right? So let's see how we can look at it in a conditional vesting model in Black-Scholes. I mean, in binomial. Now, this is a conditional vesting model. So I'm saying current stock is at 100, exercise price is 100. The vesting barrier is 200. So it can get vested at 200. So here we are saying vesting itself will not happen in 1 year or 2 years. It will vest only when you touch 200. So you can exercise only after that, right? So in an example like this, you need to necessarily build it over a period. So if you see, this is the way the tree progresses over 10-year period. I've taken a 10-year as the assumption here. And what is the payoff over the 10-year? Then based on that payoff, what will be the backward induction? So in the whole binomial model, you build a tree and work backwards. In the like the example we saw, you start from the last year. So anything below this, there is no payoff. Because if it doesn't touch 200, there is no payoff, correct? So all these are zero. So many rows will only end up in zero. And you work back from this to determine the option value at 57 rupees today. So this is how you can build a conditional vesting model using binomial, which is not possible under Black-Scholes. You will have to make some fixed assumptions within that criteria. So this is the example where binomial makes a big difference compared to the other model. Trust this was clear. We can look at questions on this also when we come to this thing. Another example. Let's take a case where it will, this is the example we saw, that it will vest only if it crosses 200 at year 3, right? So how do you do this? Here, the vesting is 3 years, but at the end of 3 years, it will vest only if it crosses 200. Now, for something like this, Black-Scholes, yes, there is a simpler model which is available. It is not any time. It is at end of 3 years. If the market condition is achieved, then it will vest or it will lapse. So when it is compared to the previous one, this is a simpler model, right? Though there is one complexity which is built in. Here, there is a way to build it into Black-Scholes also. In binomial, you go by the same thing. You create the paths and you work backwards to determine what is the possible this thing. In Black-Scholes, you can use the probability weighted valuation, right? You remember that when we talked about volatility, we also talked about normal distribution. So that normal distribution, what is it basically saying with the volatility? If this is the volatility, this is the probability that your price will be X at the end of so much period using normal distribution, right? So this is exactly what we can use to determine what is the probability and apply that. How is that built into the model is what we are going to be looking at as the next example, right? Now, this can be done in binomial as well as in this thing. So here I have taken the example that binomial, how will you do it in binomial, right? So in binomial, what is the possibility that 3 times it goes up, it becomes 269. My current price 100 goes up by 33% for 3 years consecutively, it will become 269. If it goes up twice and goes down once, it becomes 139, right? If it goes up once and goes down twice, it becomes 71. If it is continuously going down 3 times, it is 37. These are the only 4 possible scenarios at the end of 3 years, right? So in the first scenario only, it is more than 200. So it will vest an exercise at 169. In all other cases, it will lapse. Now, there is a method by which you can calculate under binomial what is the probability of reaching the first tree. It is 14.6%. So the expected payoff is 24.63 and the option value, present value of expected payoff is 19.97. I've given this in an Excel model also, so you can look at it. So using a binomial model.
I have one question, sir. The probability of
Yeah.
reaching the payoff, you determine it from the model itself as a mechanism, is it?
No, there is a formula under binomial how you determine the probability, right? The probability is see, this is the risk neutral probability formula for binomial models, right?
Okay.
On an average, risk neutral probability, right, is 0.526. Now, risk neutral probability to the power of 3, because 3 times you should get the same thing to get U3.
Okay.
That is upwards. If it has to go 3 times,
Upwards to go 3 times. Okay.
it has to be to the cube. So for it to reach only that, I have taken a simple example here. Now, if
Got it.
2 or 3
Then underline.
trees went to a vesting, then my probability will have to be calculated 2 or 3 times and then added up. So I have taken a simpler example more to show how it works. That's why whole binomial is a very, very complex building which has to be done, right? So again, let me come back here. So essentially here, the probability is not 0.5. The risk neutral probability is 0.526. It's not 50%. You can see that it is slightly more than 50%, right? So 0.526 to the power of 3 times it has to happen. So you flip a coin, normally we say no, 0.5% or 50% is our probability, right? So if second time you flip a coin, you should again get heads. It's 50% into 50%. 3 times if you have to get 50% into 50% into 50%. Same way only this is being computed here, but using the risk neutral probability under binomial model, right? So that's why I've also put it into an Excel model. So one can look at the underlying formulas and understand how it is being done. Alongside this, I've also given how the same thing can be done in Black-Scholes, which also we'll see. for this, because this is a simpler model compared to the previous one, where the earlier one said it will be exercised whenever it reaches 200. Here, it says that at the end of 3 years, if market becomes 200, you get the option. Otherwise, you don't get the option. See, some companies do this, no, because if the company reaches this valuation by 2 years, we'll give you this option will vest with you, so you get some benefit. If we are not able to build the company to that level, you don't get the option. So these kind of options, we can use this model to do it, valuation. And this kind of a simpler, this thing is easy to build into a Black-Scholes model also. So in the Black-Scholes model, the valuation comes to 18.33. See the difference. The binomial model always can give you a better valuation for complex scenarios than Black-Scholes. So there is a rupee difference between the two in terms of the option price which you arrive at. This also I will show you in Excel so that you can get an idea. But before that, I thought I will talk about it and give you this thing. So now 1 rupee difference is there. So should I always use a binomial? And let's assume if it was instead of 3 years, if it was 5 years, then the calculations will become much more complex than what I have given in the Excel sheet there. The 1 rupee, if it is going to be material for accounting only, then you should worry about. Otherwise, in this also, I would choose Black-Scholes model, which is easier to calculate and use. So these are the things which drive the selection of model to use.
So I have one question. It could be a very basic question, but just to put it out there, if
Please,
because
please.
now we have multiple kinds of options that comes in. The long gone are the kind where we have a constant period-based vesting. Now we have concept of performance-based vesting as well as part of a options rollout. Now these performance-based vesting conditions are to be rolled outside the model. You apply the model, you ascertain, and then apply the probability of the vesting, or it should also be somewhere considered into the model in any way.
It is if it is anything to do with the pricing, etc., it should be considered within the model. For example, that's what I am now showing. See, I showed you the formula which looks complex, very complex, correct? Black-Scholes. We are all not mathematicians or statisticians, right? So this looks very complex. But look at the same thing in the normal Black-Scholes model. We know these 6, right, inputs which we have to give. We only add one more vesting threshold 200, right? And we change this one formula. It used to be D3 by D4, which is price by exercise price in the normal course. Now we have just changed it as D3 by D19, which is the vesting threshold. And lo and behold, we have the 18.33, which by the complex method also you have arrived at the same thing. So some simpler things can be built in very easily into the Black-Scholes, but some of the things you will have to do a binomial one if it is very complex. Many a times we take a balance between cost benefit. See, everything ultimately comes to that, right? What's the whole purpose of this accounting? Now, if the ESOP, see, generally look at it, ESOP itself will be less than 5% of the company's shares. And the cost coming from that is normally not likely to be very significant in the debit to the P&L, except in some startups and things like that, where there could be some substantial debits which are coming, right? So many a times we try and see if we can make some assumptions which could easily fit within the Black-Scholes model, which is easier to apply, than make a complex building, right? Complex structures to be built requires a lot of mathematical and statistical understanding and doing that computation. So there are no ready formulas available. Ready formulas are available, we can use it simply. But when it becomes more complex, then ready formulas may not fit. So you need to build your own model. That is where these things become easier. The second possibility is using Monte Carlo on Black-Scholes. Instead of going to binomial, I would choose Monte Carlo and Black-Scholes because Monte Carlo is just iteration. Excel can do iterations, no problem. So I will assume time to expiry as 3 years, 3.1 year, 3.2 year, 3.3 years as a random. Do 5,000 iterations and do a valuation basis that.
But would you
So
have to
these-
do a probability for each of those iterations, saying that there is a probability of this happening?
That is what you need to build, yes, right? So, for example, take the case I talked about where 100 rupee share, 30 rupees is the current, this thing, it's already listed, and 30 rupees is the exercise price, and current price itself is 100. There is a 10-year vesting period. So I can make some assumptions about probability. See, I think 10 years back or so, when I gave the valuation report, I assumed that it'll all get exercised in half a year, basis some rationale we gave, and we gave the report. Today, probably I would say that there is a X% probability that it will get exercised within half a year, Y% probability it will get done in 2 years, something like that, more graded, probably, right? Probably that is possible. But then to make such assumptions, you need some data. Whether such data is available or it's going to be judgmental call. Now, if I'm going to make 5 judgmental call about 5 probabilities and then do it, I would as well rather make an average judgmental call that, you know, on an average, it will all be sold within half a year. So it essentially comes to the 2-3 things. How complex is the method? What kind of data is available? And what kind of judgment calls we can take on that? We sometimes meaning management, not necessarily only the valuer. And how material it is. Most important is that how material is it? If it is not material, see, for example, the same thing, you look at it binomial and this, there is a 1 rupee difference, roughly 1 rupee difference. Now, if that 1 rupee on the total ESOP could make a huge difference, then only I should look at which method to choose and all that. Otherwise, it doesn't matter. I can use whichever method, makes little difference. So sometimes these complex things just simply fits into the standard Black-Scholes model with some small tweaking. So market triggered vesting, which is one of the complex formulas we regularly see now. Like in the case you are talking about many times, this performance-based vesting is a market triggered vesting. They essentially say if the share price reaches this, you will get it, otherwise you won't. Fine, that can easily be built into the Black-Scholes. So again, there is no need to go into complex building under binomial. Now, these are some examples I wanted to take so that we can look at where we move from Black-Scholes to using binomial, etc. Now, if you really look at it, why are the Western world using binomial more and less of Black-Scholes? 2-3 reasons. One is they have a much more developed and long established valuation practice. And their valuation practice is not coming primarily from accounting background. It comes from statistical and other backgrounds. So they all work with very complex models. They are already doing complex product valuations for various other purposes. Now, for example, we all talk about valuation so much. If you if you look at how many of the valuers are really into and have the capability to do valuation of, say, some complex financial products, right? Like if there is a collar forex option or a forward. Now, those kind of things, very few people have that ability to do it, or the capability to do it. So it gets limited. There is a larger chunk who's there and who are doing it, and many of the firms are also doing this on a regular basis. So they have more complex models which are readily available with them. So they use more complex models with which they can fit in better. So it's the example I always give. You know, when you go to weigh yourself, weighing machine, you get onto a weighing machine. The weighing machine which we use to weigh ourselves might have a error rate of maybe plus or minus 2 kilos also, it's okay. Whereas when you go to weigh, let's say a rice or dal which you are buying, plus or minus 100 grams should be the error range, or even less. But when you go to buy gold, it is in micrograms. The error range has to be in micrograms, right? So obviously the finesse with which you are going to look at and the accuracy levels we are going to look at depends on the purpose. ESOP valuation is largely for accounting, so it's an estimate. So you can apply materiality to an extent within reasonable bounds. So you don't have to necessarily go for the most complex model always, right? What is pragmatic is what we can look at. I also wanted to touch upon another important thing which, sometimes have been raised to me as a question. Sometimes I have found that this is something which has been missed out. Especially this can have an impact in, again, startup kind of scenarios where the ESOPs could be a significant portion. So this is another thing which I wanted to talk about. What happens when you are doing a valuation for, say, fundraise, and there is a ESOP scheme in the company? How do you deal with it? Is one major thing which we need to look at. All right. So I'm just giving some thoughts on it, and we can discuss any further questions on that also as we see. Let's take a simple example, right? Company A has 1 lakh equity shares to its 2 promoters equally, 50-50, right? They have also implemented an ESOP scheme, setting aside 10,000 equity shares for the ESOP scheme, right? Nearly 9%, so on a fully issued basis, theoretically. Exercise price is 50 rupees per share. Discount rate considered is 15%. Of these 4,500, out of the 10,000, 4,500 were granted. 5,500 are yet to be granted. Then out of the 4,500 granted, 2,000 has vested, 1,000 have expired. Balance 1,500 are yet to be vested. So these are the numbers we know about. Let's assume the company has no debt or other instruments, for making it simple. And let's say the enterprise value has been determined at 2.5 crores. Now, the question is 2.5 crores divided by 1 lakh shares. Is my share price 250, or it should be something else? This is always the concern. And sometimes I find that this has been completely ignored or has been considered partly, etc. So I'm going to share my thoughts on it, what ideally can be done in the scenario like this. So 2.5 crores is the enterprise value, right? And as there is no debt or this thing, this should be the equity value also. But what is the divisor to determine per share value? So let's take the examples. I think here also I can take you to the Excel. Now, there are broadly 4 possible scenarios you can consider. Only issued shares are considered. That is, you don't consider anything under ESOP because it's not share issued, right? Now, in such a scenario, what will happen is 250 lakhs is my valuation, 1 lakh shares are issued. So average price will be 250. Average price will be 250. There is nothing else which is there, right? Now, this is scenario 1, which in my view is not appropriate generally. Generally, not appropriate, right? Then, second option is where we consider what is vested and to be vested. So in the scenario we were looking at, we saw 2000 is vested and 1500 is to be vested. So I have already granted something where 1000 have expired, 3500 is out there in the market. I cannot ignore it, right? And the employees can take it. So in a scenario like that, vested is 2000, to be vested is 1500, so the total is 3500. So if I take, I'm assuming here 100% will get exercised, right? That is also another factor which can be put in. For simplicity's sake, I have just taken that as 100%. So maybe you can take 90%, 80%, depending on what is likely to happen. But more conservative way of doing it is to assume that this will be taken, especially because if you are going for a fundraise and there is a possibility of better valuation, obviously this will be taken. So 103,500 is the total shares. My enterprise value as of now is 250 lakhs. I will also get a ESOP price of 50 rupees. There is an exercise price of 50 rupees which has to be paid by the employees when they take the 3,500 shares. So the 3,500 shares at 50 rupees, now I am taking a discounting rate of 15% because I will get that money only after say 2 years. I have assumed here 2 years. Again, for simplicity's sake, I have assumed 2 years. It could be modified. So the present value of that is another 1,32,000. So 2 years later, when these are exercised, I will get 3,500 into 50, say a 1,75,000 rupees. That 1,75,000 rupees present value is 132,325. So if I take that 250 lakhs and this 1,32,000, my total adjusted value comes to 251.32. My adjusted number of shares also goes up to 103,500. My average price comes to 242.82. Now, when is this more appropriate? Where the fundraise transaction also provides for accelerated vesting and cancellation of the scheme. So typically, in some cases, what they will say is, okay, whatever you have already given, it will vest immediately. Let them decide whether they are going to exercise or not. Generally, everybody will exercise because they will make money. And then the scheme is cancelled. We will come with our own thing. When companies are acquired, these kind of things happen because they don't want too many schemes floating around everywhere. If a strategic buyout is being done and this company is being acquired, it is quite likely that the scheme will get replaced. If it is a private equity investor who's investing into this company and the company is going to remain as it is in operationally, then the scheme may continue. So this is more relevant when it is likely that the scheme will be cancelled and what is there only will get vested and closed, right? The next possibility let's look at, where we take vested, to be vested, and to be granted also. 1,000 has lapsed. Other than that, out of the 10,000, 5,500 is to be granted and 2,000 is vested already, 1,500 is to be vested. So I am expecting all this to be available to employees in due course, right? So I take 1,09,000 as my number of shares. Then similarly, I also need to adjust the value which I will get. Again, here I have assumed 2 years for simplicity's sake. You can take a more reasonable estimate of time frame in which you will collect this money. Adjust that, and the average price comes down further to 232. Now, where is this more relevant? Where the transaction provides for continuation of the scheme, but the scheme does not have a reissue feature for forfeited options. So the 1,000 shares which lapsed, if there is no option in the scheme to reissue that, then you can use this model. The fourth is the other extreme. I take the whole 10,000 because this 1,000 which is lapsed, also the scheme provides for forfeited shares to be reissued or lapsed shares to be reissued to others. So it comes back into the pool. So I'm maintaining a pool of 10,000. If that is the case, then if the scheme is drafted like that, generally a lot of schemes will be drafted like that. But I just wanted to differentiate all these things, right? So this happens when, let's say, the PE investor is investing. So the scheme is going to continue, like in the previous case also what we saw, right? And the scheme also provides for reissue of lapse options. So basically, it's a pool from which it is being done. And the pool is limited to 10,000 shares. So in a scenario like that, it could be also be adjusted and the average value could be about 230. So see the difference from 250 to 230, it could vary, right? Now, whenever there is an ESOP and we are doing a valuation for fundraise, etc., and we have to determine per share value, we need to also consider this. Now, not only when there is for a fundraise, maybe for conversion, any purpose when we are doing, we need to apply our mind. I'm not saying there is one rule which can be applied. Here itself, we saw there are multiple possibilities, right? How we will deal with it. There are multiple possibilities. The same way, there could be multiple possibilities in how we deal with the scheme in our valuation. In any valuation we do, when there is a ESOP in the company, we need to appropriately consider, apply our mind, maybe give some reference to it to show that we have applied our mind and taken a judgmental call, how we have dealt with it. So, like I said in this Excel sheet, before we go back, I just want to tell you, I have given the Excel templates, which shows the volatility, a very, very simplistic binomial model, Black-Scholes model, which can be used under all this thing, the Monte Carlo, how you do it. And this example, which I did, I have given a comparison between Black-Scholes and binomial, especially where there is a vesting criteria, how it can be used using the standard Black-Scholes model itself, because this is one of the variants which are frequently encountered in the Indian context. Then how to build a whole tree in a conditional vesting scenario, and how to deal with ESOP under various possibilities as an example, right? So this also I will share when I give the whole file. So coming back, these are the 4 possible ways in which you can deal with the ESOP in a fundraise scenario. I also wanted to touch upon accounting a little bit here, because on accounting there are some implications which will come. And this also touches on the multiple tranches or multiple vesting, how to deal with it. So let's start from the basics, right? Under IGAP, though fair value is the preferred method, intrinsic value method is also accepted. The difference, see, we have to understand here when we talk about fair value method and intrinsic value method, it is the value of the option and not value of the share. Fair value of the option, intrinsic value of the option, right? Because there is also a fair value of the share which will come into play. Now, in an intrinsic value method, we do consider the share value on the date of grant. Let's say the share value on the date of grant is 200 and the exercise price is 200, then there is no option value at all, because it does not consider the benefit coming because of the time value and the possible volatility in the share price in future, etc. Right? So this is the intrinsic value method, which is also only a permitted method under IGAP, but not the preferred method. But many IGAP companies simply go with this because it is very, very simple and there is no need for getting any valuation report, etc. The fair value of option model under Ind AS, this is the only method which is accepted. The intrinsic value method is not accepted. So in that, what you do is, let's say the same example we take, fair value of share is 200, exercise price is also 200, but this may give a option value of 50, say 50, right? Calculated using Black-Scholes or binomial model. For example, you take this case, we saw here 100, 100, right? With a 5-year period, you are getting a 33% volatility. You are getting about 40 rupees as the value of option. If I go by intrinsic method, 100 minus 100 is 0, so nothing needs to be accounted. Whereas if I go by the fair value of options model, then 40 rupees will have to be charged to P&L over the vesting period. So this is the key difference which comes between the
Sir,
two.
I have one question, sir.
Yeah, please.
How do I push back with any of these big fours or big fives when they insist on a fair value method for an IGAP case? Do I have enough reasons to push it back?
There is no need for enough reasons. If you go to the, if you look at the IGAP, in IGAP, there is no standard equivalent to 1 or 2.
We go to the guidance note.
Yes, so there is a guidance note. The guidance note says the recommended preferred method is this, but it is also permissible to use the intrinsic value method. So once it is permissible, all you have to do is give that as your policy and go ahead. So
Okay,
there
we
cannot
just
be
have
any
a
pushback
disclosure in the notes
true and
and
fair.
we just go on.
Yeah, absolutely. It's a policy choice which is made available. So the question cannot come on true and fair at all on this.
Sir, do you practically push back and tell them that it's not required and adopt an intrinsic value method?
I have never seen them push for it in a IGAP scenario where the policy itself says this. So that is what practically happens. See, generally on the ESOP valuations, the more questions on this thing will be on choice of the variables which are used, etc., which goes around and round. But I have not seen any real pressure or this thing that you should use only fair value method and not intrinsic value method in a IGAP scenario.
Thank you.
Of course, there is a difference. The guidance note earlier put both as this thing here. Now the new guidance note, they have said this is the recommended choice and that is permitted option.
The fair values,
there is a so there is a slight difference between the guidance note which was there earlier and the
Right.
guidance note which is there now for IGAP. Where earlier this thing was much
Earlier
more.
one was very, very accommodative, the previous guidance note.
Correct.
The
Now
problem
it
is trying to
is.
bring it in line with IFRS now.
Yeah. See, actually, in most cases, it takes 5 minutes to do a Black-Scholes model value. So it's not very difficult. It's only the question of debit to P&L.
Debit to
And
P&L
the-
is the bigger question, sir.
Correct. And the consequential impact it has on how it is treated for tax, etc., etc. All that also becomes an issue. So it's still a choice which is available, so they can put a policy accordingly and move forward. Because it's not, the guidance note is not prohibited, it's permitted. So let's take an example under the option valuation method, right? Let's say there are 1,000 employees covered by the grant. Number of grant per employee is 200. Vesting period is 3 years. And expected life is 5 years, factoring early exercise. Exercise price is 25 and grant date price is 25. Forfeitures per year is 2%. So every year I expect 2% of people to leave or etc. So because of which there will be forfeiture. Estimated fair value of option, instead of calculating, we have just taken around 10 rupees, easier to calculate, right? Now, estimate of forfeiture and actuals. So end of year 1, 2% was expected, but actual lapses were 3%. End of year 2, 4% it was. End of year 3, it doesn't matter because 840 employees completed. Out of 1,000 employees, 840 completed. So you know the actuals, right? So we are also going to look at how to give effect for this in the estimation. So first, let's look at the grant date. Grant date, 1,000 employees, 200 grants. 2 lakh grants is what is being given, right? Now, out of 2 lakh grants, we are expecting at the end of 3 years, how much to mature, right? Be available or actually vest. We are not expecting the whole 2 lakhs to be vesting, because we said our estimate on the date of grant is 2% per annum forfeiture. So it will be 2 lakhs into 0.98 into 0.98 into 0.98. So which will be 188, 238. That is every year we are expecting 2% to go. So 188, 238 is the expected options to mature. So this is the first thing. I was telling you that in the US GAAP and all that, this 2% would also be built into the pricing itself. So you will not adjust the number of options granted, but in the IFRS or Indian GAAP or Ind AS concept, you will adjust for it in the number of options for which you are going to book costs. So as against 2 lakh options which you are granting, you expect only 188, 238 to mature. That 188, 238 into 10 rupees is 1 crore or 18 lakhs, 82,000 is the amount to be accounted. Now 18 lakhs 82,000, you will not account the whole thing. You will account only 1/3 of it in the current year, because you are expecting it to be done over 3-year period, correct? So 1/3 is 624,460, which will be the debit to P&L in year 1. By second year, you already know that you have had a 3% loss. Actual loss was not 2%, it was 3% lapse, right? So it is 2 lakhs. You adjust it by 3%. to arrive at 179,947. Then obviously you need to account less value to your cumulative cost. In that 627 has already been accounted in the previous year. So the balance only will be the debit to that year's account. By end of third year, you already know 840 people got 200 shares, 1,68,000 shares. So 1,68,000 means your cumulative cost should be 16,80,000. Out of 16,80,000, you have already provided 11,79,000 till last year. Balance 5 lakhs you will provide now. This is how the accounting will come and fall in place up to vesting. Up to vesting, what happens? It goes into P&L, right? Now vesting has happened. 840 shares got vested. Now what happens when it gets exercised? Another couple of minutes, we'll finish this and then take questions, all the questions. At the time of exercise, whenever the exercise is happening, you will take the options to capital, premium, and close out the stock option reserve of 16,80,000. Now, after 800 exercised, 40 got expired. Now that 40 which expired, what will you do? You will move it from stock option to general reserve. You will not bring it back to P&L. Any lapses which happen prior to vesting gets adjusted in the debit to P&L, which is what we saw is happening in the calculation when we changed the 182, 238 to 176 or 168, right? The estimated options, because it is pre-vesting. Post-vesting, the amount which has been credited to stock option reserve will only be moved from there to general reserve whenever there is a lapse. This is the key criteria in accounting for this. Now, a complexity comes when the various criteria changes. Now, if the length changes, you accordingly vary it next year in the values which you are accounting. First, it was 2 years supposed to be. So 188, you actually took one half of it into that year. By next year, let's say the vesting period was increased to 3. Then you have also applied the same correction. 176, 947 only you will give. Then your debit, you adjust it in that period. Whenever similarly the grant also changes, instead of vesting period, the number of options which you are giving, instead of 200, it's going to be, originally it was thought to be 150, then 225, then it became 200. Again, the computations will vary accordingly. But in all this, you look at the case where exercise price changes based on some performance criteria. If the exercise price changes, there is a need to recompute the option value, because exercise price will automatically impact the option value. So exercise price changes, you recompute the value. So 10K may become 12 rupees by the exercise price changing, theoretically. So you recompute and calculate, right? So in the case of SARS, in SARS, what happens is you are going to pay them in cash. See, in normal ESOP, you're going to pay them in equity. So you do a grant date valuation, you don't change it. But in SAR, you have to pay them cash. So ultimately, on the day when you are going to give them money, you have to have that day's value. So because of that, in the case of SAR alone, there is a need to revalue at every period end to find out the fresh fair value, because the market keeps changing. You have to keep finding the fresh fair value of the option. And as you go closer, your fair value and intrinsic value will match. And once it is exercised, you will start using the intrinsic value, which is the actual share value itself, and start providing by that till they exercise. For example, the shares, 200 options you have given, and you have said anything over the 25 rupees, we will pay you in cash, right? So if the share value was 25 plus 18, 43 in year 4, you would have accounted based on that. By year 5, it becomes 22 rupees more. That is, say it becomes 47. That differential 4 rupees you have to book as expense in that year because you have to pay out cash. You have to create a liability to that extent. So the liability is restated in the case of SAR alone on an annual basis by fresh valuation, whether it is during the vesting period or post-vesting exercise period. So this is one key change in the case of cash settled schemes where there is a need to continue the accounting. And I have given these workings for you to also look at. With this, I will now go on to look at the questions which are already there in the chat box, and then any other questions also we can take. I hope the chat box is visible to everyone. I'll go from the top. Assumption under Black-Scholes is if there is a variation, how do we give effect to the same in valuation post the number is arrived? Slide 11, right? So let me just take you to slide 11. So any change to this, like for example, dividend, I said we can put this thing. The key thing where there could be a change is the European option, which I told you by taking an assumption on early exercise. Instead of taking the full exercise period, you can take a part exercise period for computing. That's how you end up addressing that. Slide 14, should you have different valuation done for different lot? Yes, each tranche will have to be valued separately. For example, if you are giving to employee A today 10,000 shares, 2,500 vesting in each year in the next 4 years, the 4 tranches should be ideally valued separately because the risk-free rate will vary for that period. The total exercise expiry period will vary for the 4 tranches. So it is ideal that these are valued separately. Then the next question is, I think, what happens if ESOP are granted and vested for past 3-4 years by the company, but they have not recognized any cost or done any valuation for the same? Implications and recourse to be taken by the company to get it back on course, track with compliance. So treat this as a prior period error under Ind AS or IGAP and accordingly account for it if it is material. If it is not material, you can account for it in the current year, giving a note. So all the last 3-4 years costs, you will have to charge it to P&L or reserves as the case may be, whether you are under IGAP or Ind AS. Time period on other valuation undertaken for fresh issue around that time can be valid for what time? See, there is no general rule or something, but if you look at it, let's say, see, I'll give you 2 examples. Okay, I did a very interesting study. Many companies which went for listing, I did a study of the ESOP valuation, say, in the previous year. Previous year ESOP valuation to listing time price, there was nearly a 50% gap. So it was half the price, right? That is possible because the earlier part it was unlisted. Now, in a listed company, you can't have a significant difference. That is one side. So let's now take the second case where we are looking at only unlisted company, where there is also a fundraise round which is happening, and there is also ESOP which is being valued around the same time, ESOP grant. Now, what is around the same time? Maybe a 3-month period, 6-month period in general, because normally things do not significantly change in a 3 or 6-month period. But if there has been some significant change, you need to factor that, right? So that is something which can be considered. That's why I said on a case-to-case basis, you should understand what is the recent period valuations done. So typically, normally what we do is we take a list of all valuations done for that script the last 2 years or so and keep a file note as to what is the rationale if we need a rationale for a significant change. SAR is basically a stock appreciation, right? Basically, instead of giving them equity shares, we are saying that whatever is the difference in price, we will pay it in cash, which means the company will have to shell out money. See, when I give a paper, I can account it at 20 rupees, I can account it at 30 rupees, even though today's value might be 100. But when I have to give cash, I have to find 100. No, I have to account 100. So that 100 has to go to debit. That is why the liability will have to be re-established every period for SAR, any cash settled scheme, basically. Risk-free rate, continuous compounding rate or simple rate is sufficient. Sometimes this is questioned by the Big Four auditor. What does standard practice suggest for? See, there is a guidance which is available in the standard itself, right? I think P14 or something paragraph. I'll probably. P34 of India. It says what you should ideally take. So you go by that, you are there, clearly there. Where is the, Can you help us in sharing an example of implied volatility for cases where options are traded? How one could check the same on any website or so? Yes, generally stock, wherever there are forwards traded and all that, options and forwards traded, implied volatility is also one of the items which are getting published itself in the data. You can take from that, should not be an issue. The presentation and the Excel sheet, I will share it to BVA for them to give to all the participants. It's surely something I can add. ESOP value to be added to EV for arriving at fair value. It is not the ESOP value, it is the exercise price which will be collected. See, I'm going to issue some ESOP. Let's take the simple example of 10,000 ESOP, which I am going to issue. That 10,000 ESOP, whenever I issue, when the exercise happens and I issue, there is an exercise price of 50 rupees. So 15 to 10, 5 lakhs is the cash I will get at some point of time. That 5 lakhs is not today part of my enterprise value of 250 lakhs. So that 5 lakhs current discounted value I can add.
Mayun.
So that is what we are talking about there.
So that means, sir, it should be added.
Yes, yes.
Okay, before dividing with the number of shares, right?
Correct, because I am also taking the ESOP as a denominator. In the numerator, I add this value which I will get in future. It's present value. So we can make some assumptions. It will come in 2 years, 3 years, depending on what's more appropriate for the entity.
Thank you.
Apart from valuation of ESOPs, do the valuers have to guide the company's accountant as to how much to be allocated to P&L account and how much to general reserves? See, there have been cases where I have got a query for purely accounting advisory, not even the calculation or valuation, accounting advisory. How to split it, how to spread it, monthly account, etc. In fact, the standard report used to be given like that. In fact, that is why for a grant made in, let's say, 2023, there is no need for further valuation or further input from the valuer. But some companies do come back saying, this is our lapses, this is our, excuse me, this is our current position, etc. And ask for the accounting advisory as a note itself. Basis only they go and account it. Of course, it's purely a accounting advisory, not valuation. Now, I think I have finished the questions which are there on the chat box, so we can look at any other questions any of you have. Please put up your hand or open up and talk straight away. We can discuss. I think there is one more new here. Yeah. All are generally unmuted only, no? So I think you can raise your questions, any questions on ESOP, we can discuss.
I have one question actually. This is Sanjay here. So typically, typically ESOPs are given by startups, correct? Because they want to make sure that the employees are sticking to them on a long-term basis. And what happens is that if we take the ESOP charge to the PNL, the PNL really goes really adverse than what it is. Correct? Already they are running into losses or maybe they're bootstrapped, etc. When you put this, so how do you present it? I mean, what impact does it have today on the investor world when you're getting funding, raising? You're looking at a very bad balance sheet or PNL, correct? So how do you manage those expectations? It's more from a practical aspect rather than an accounting aspect. So any thoughts, any views?
Yeah. So actually, most of the fund kind of investors are very aware of this, and they take it in the stride. They know that these are part of the growing up requirements. So they take it as part of the pinch of salt. They don't even look at it as a critical this thing. The one way of presenting it would be also to show adjusted EBITDA, where you show these as adjustments and say, prior to all this, this is the kind of EBITDA which is being made, etc., as part of the pitch, how you present it to the investors. So, and then do a comparison with the fully grown, mature industry, how their EBITDA and this is comparable or will compare over a period, etc. That's how you make a pitch. So typically that is what is done.
So when we are making the valuation, correct, you said that we have to arrive at the equity value. At that point of time, do you factor that to be issued ESOP and then value the shares, or we just value the shares without the ESOP? So when we are doing that exercise,
as I was mentioning, I consider based on what is this plan going to be, right? What is the plan going to be? Accordingly, only we'll take. For example, wherever the scheme is going to continue and the scheme is going to be fully operational, we take the full ESOP.
So the 3 models that you had shown, or 4 models, like
yes,
vested up till now or to be vested and the probability thereof, we take that into account and then value the shares. Okay, got this.
Mr. Balasubramanian, good morning.
Morning.
Quite a good
Sorry, but a good presentation. Thank you very much indeed. Just one question I want to ask. See, apart from this ESOPs, sometimes the company gives buyout options to the shareholders. Of course, sometimes they also give right issues. In such cases also, do we calculate this type of ESOPs, I mean, this type of application of Black and Scholes formula, something to value these buyout options, especially when the financial closing is taking place?
Sir, for example, the same Black-Scholes model is used for computation where the company is issuing, say, an optionally convertible debenture, things like that.
Okay.
Yes.
Yeah.
Any optional instrument which is issued by the company under Ind AS, we do use this at the time of issuance of the scrip for valuation. Now, if there is a agreement for the promoters to buy out, then that does not come into the this thing, because it's not the company's responsibility. It's only the promoters buyout option. So many times the promoters will also agree as shareholders to do one of the two things: either that they will buy out or they will cause for a buyback by the company. Even that is not an option contract for the company. For the company, it's not an option contract. It's only one of the mechanisms by which an exit will be provided. So there also nothing is done. But wherever there is a OCPRS or OCD, etc., being issued, yes, evaluation is done. There are two methods there under the standard which is prescribed, which is first is they say you identify the liability value, then the difference you take it as equity. Or you identify the equity value, take the difference as liability. So in a compound instrument, you can approach from one of the two angles. Depending on which they take, they may use Black-Scholes.
Okay. So nice, so nice. And what about the sweat equity? Does it have to be valued?
Sweat equity is also valued, but generally sweat equity is given, I mean, assuming it is given free and it is immediately given as shares, it's not treated like an option, but the share is valued and accounted for.
So nice. Thank you very much. Thank you.
My pleasure, sir.
The option that you were telling just now with respect to buyback facility that is given to the ESOP as an exit, one of the mode of exit. So what happens to that will be considered as expired option, and then to the cost, it will be adjusted in the amortization table, point number one. Point number two, the tax treatment when the company is buying back. So that will become an income for the shareholder as a perquisite, or it should be considered as other income. How the TDS implications to be done when the money is paid by the company to the employee?
See, if a ESOP, right? Let's assume in a case of a private company, right? A private company where, because there is no marketability for the shares, if the company is going to give a ESOP with a buyback option, right, for encashing it, then there are two things which is happening. On the date of exercise, first and foremost, the fair value of the share will become perquisite value in the normal course because it's ESOP. It is only then the next thing happens that the shares are being bought back for cashing out, right? These are two separate transactions. Unfortunately, today buyback is not a good option. Buyback will get fully taxed as equivalent to dividend in case the company has profits, accumulated profits.
He's wearing her watch.
So it is very rare that companies give a buyback option today. They will create trusts with which they will route it rather than through this thing. But theoretically, yes, it has to be treated as two separate transactions. The ESOP being given is the first thing. The second is encashment of the shares. So encashment of the shares will be a separate thing. So in today's context, if somebody was to give a fixed buyback model, I would advise them to relook at it and restructure, because this is bound to have unnecessary tax implications or litigation. You may, I mean, down the line, there could be a favorable case for assessee, but as of today, it's a big risk.
Thank you, sir. Thank you.
Yeah.
One associated question I have, only
Yeah,
in the
please.
context of when you use the concept of a trust. Now, this is more on a tax. Sorry to ask. I thought it was a good place where I can ask. When you have a tax impact through a trust, and you have to use a 11UA concept, do you by chance do on a fully diluted basis, or do you do it based on only equity shares, sir?
First thing, let me tell you, if you are giving us ESOP under the tax route, whether you use the trust or you don't use the trust, the taxing is the same. But when you are going to not go under the ESOP for tax purpose, you are going to create an employee welfare trust where you are going to trade some shares, then that trust may become a private discretionary trust and taxed in its own hands. In such cases only, you could use other things. In case it's an ESOP, you have to go, whether you are using the trust route or direct route, you have to go by the same basis only. Same basis only. There will be no change in the method.
But
So there is no
not on
11UA.
there is no impact on the employee, but trust per se, when it makes a transfer, it would be considered as part of 11UA, no? Because it is a separate entity and it is transferring to the employee. Or do you consider trust and employee as the same, and hence there is no 50CA implication?
Correct. Yes, there is no implication there. If it is a typical structured ESOP trust and approved like that. See,
But,
if you are setting
is
up
there
a
any
ESOP trust,
citation
yeah, please.
available, sir? Because we have any citation that has been there to support this?
I will have to check. I wouldn't have handled tax litigation per se, but I'm sure there will be. Sure, there will be.
Because we have had multiple cases and we generally dissuade them from having a trust for a unquoted equity share because of the menace created by 50CA. So that's why I just wanted to have a practical view. Do you say the trust and the employee is one and hence there is no implication?
Yeah, there are enough and more this thing which would be there, because even in the general concept of trust, where these are identified beneficiaries and identified assets to the beneficiaries, it is only the beneficiaries' hands. But I really don't know whether there are ready-made case laws or citations which would directly support. I need to check with my tax team. I'm not the expert there. Thank you.
So just wanted to
If you
pick
can
your
send me
brain.
your mail ID, I can get something and share later.
Oh, that would be great, sir. I will send it across,
No
sir. Thank you so much.
Yeah, please do. My mail ID is also in the presentation itself. Anytime, any queries, I'm happy to be. There are no queries, further queries. Can we close for the day? I think we have also run out of time now.
Thank you for the wonderful deliberation, sir. It was extremely useful to all our participants. I'm just looking for Khushbu if she is available for vote of thanks. In case she is not available, I would want to take this opportunity to thank you wholeheartedly for your time and for the guidance that you have extended to our members. I'm very confident that all our members have benefited, and we look forward to more such presentations from you and sharing of experience, sir. Thank you so much. And as a
Thank you
part
all.
of from BVA side, we will be sending you a memento that will be couriered to you shortly.
Thank you all. Thank you.
Thanks a lot, sir.
Thank
Thanks a lot.
you, sir. Thank you so much.
Thank you, everyone. Thank you.
Sir, on behalf of BVA, we would like to present this memento to you.
Thank you.
Excellent session, sir, and hope that in the near future we have more sessions from you on various topics of valuation.
Absolutely. Thanks. Thanks a lot. Thank you.
It was a pleasure, sir. Thank you. Thank you all.
Thank you all. Bye. Have a great day.
Same to you, sir. Thank you.
Thank you, sir.